This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, February 3rd at 7:45 a.m. Mountain Time. Our note this week was titled Inadvertent Monetary Policy Rebalancing. We didn't spend a lot of time on trade policy. We'd covered that the prior week, and the main takeaway was tariffs are going up. Our response to the flash CNBC survey that Steve Leisman and team sent out this weekend was that the tariffs on China, the tariffs on Mexico and Canada were unlikely to persist. Kevin Hassett, who's going to be the head of the Council of Economic Advisors, made it pretty clear on CNBC this morning that those are all about the drug war, not about trade policy, but that the tariffs on China would persist and would likely go higher. And we thought that the end of the de minimis $800 exemption was particularly noteworthy. That's been our stance on tariff policy, that we unilaterally disarmed. We charge lower tariffs to our trading partners than they charge us, and they're likely to go higher, including on Europe over time. One of the things we did not discuss in the note this week, but perhaps should have, was this will be Treasury Secretary Bessent's first quarterly refunding announcement. This afternoon, we'll get the financing needs, and on Wednesday, we will get the composition between bills, notes, and bonds. We doubt that he will make a wholesale change this go around, but both he and Stephen Moran, will be the head of the NEC, has made it clear that they thought the Yellen Treasury's reliance on bill issuance at over 30% of the total was ultimately risky and not the right thing to do. So we'll be listening for clues that they're going to extend duration over time. The note had four really robust sections in it. The first one was we're going to need a bigger moat. It was a reference to the deep seek shock that we had a week ago at this time. Our main takeaway was that the energy demand is not going to decrease over time. If anything, we think companies will want to protect their own data, maybe even move away from this outsourcing of data storage to Amazon, Microsoft, and Google, and want to protect their own data. So energy demand is definitively going higher over time. We realize some of these power stocks had parabolic moves and we're in need of correction, but demand for things like natural gas are going up over time. So we remain bullish the energy sector. We then went through GDP, and we described it as a consumption boom, but investment bust, and walked through just how weak non-residential fixed investment is. Now, that could have been election year uncertainty related. We've seen a big surge in capital spending plans, but we would also note that policy sequencing matters. You go back to 2018, the Tax Cuts and Jobs Act caused a big boom in business confidence, but that boom was quickly reversed when the trade war took hold. So we were hoping President Trump would slow walk the trade stuff and get some of the tax policy taken care of at the same time the government gets spending under control, which stabilizes the back end of the Treasury market. That sequencing is still pretty key here to how the market proceeds through the course of the year. The biggest part of the note and the title of it was about rebalancing monetary policy. And we've long maintained that the way the Fed went about the tightening process was very awkward, and it put an undue burden on small businesses, small banks, floating rate borrowers because of this aggressive rate hikes and passive QT. Now looks like QT could continue through the whole of the year. Powell made some comments about this. We did some deep analysis on it. Become a full subscriber and you can really get into this. But we do think that there is no signs of tightening. Bank reserves have been stable. And if Treasury Secretary Bessent does extend duration, issues fewer bills that will drain less bank reserves than it would otherwise, and allow QT to continue and have a much better balance between those long rates and short rates, essentially sustainably disinvert the yield curve and help small bank profitability, which will reopen the credit channel to smaller businesses. So the final real important section was a section we called the threat to bureaucracy. And we were just fascinated by the RFK hearings last week. And we went back, though, to things that have been going on for decades with the healthcare sector. Margins have been falling for 30 years. Margins in the staple sector have been low and stable for years. These companies, the food companies, the drug companies, have not been good stewards of capital, not been good places to invest, and certainly not leading to the betterment of mankind either. And so we really do think they're in need of disruption. The idea that RFK would take over Health and Human Services, Jay Bhattacharya taking over NIH. I hope we're not mispronouncing his name, but likely could be. And Marty Makary taking over FDA. These are the right, super smart kind of guys that are just hell-bent on forcing these companies to just face the fact that they're not providing good outcomes for the public, and they're not being good stewards of capital either. And so we really do hope that we get serious disruption in the food, drug, and healthcare industries in aggregate. So on balance, we do not think that the trade war is going to be the cause of a big equity market correction. We may very well get one, but it's more likely to come because 10-year treasuries retest 5%, forcing Congress to actually cut government spending. And that's how, if we are going to get a pullback at the beginning of the year, that's how it's far more likely to occur. Just the process of getting through extending duration of treasury issuance, continuing QT, and getting to a more stable environment. Again, our underlying assumption is that government spending needs to be cut to 20% of GDP from its current 24 to 25% path for us to stabilize the debt and ultimately stabilize the markets. So that's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. Please consider becoming a full subscriber and getting all these details. Have a good week. Thanks.